as markets are stalling a bit ahead of those Nvidia earnings, Fedspeak is continuing. We had Fed Governor Christopher Waller saying this morning that he needs to see several more months of good inflation data before, from his perspective, cutting back on rates. Now, traders still pricing in 2 rate cuts this year. That is according to our beloved CME Fed Watch tool. But even in a higher for longer environment, our next guest thinks that earnings growth could give markets more room to run. Here in studio, we have Jose Rasco, HSBC Global Private Banking America's Chief Investment Officer. Jose, thanks for coming in studio. We appreciate it. We're talking a little bit here about the Nvidia of it all and the Fedspeak of it all. From your perspective, which one is going to drive us into the close at the end of this week? Is it going to be Jensen or Jay?
Well, I think a little bit of both probably, but I think, and the market is rebalancing risk and reward, right? And that's what you're seeing play out, which we see all the time. And I think what you just talked about is key, really key. Remember 94, 95. You guys aren't old enough to remember that, but I am, clearly. And if you look at 94, 95, the internet came in, internet companies did well, but they made no money. Multiples soared, right? And that was risk. Multiples have not soared here. We have a long way to go on multiple expansion in this market still. Number two, the broadening out, the convergence of technologies, 1 and 1 equals 3, and the diffusion of those technologies throughout the economy. You talked about AI. If you're in the movie business, if you're in the energy business, you're using AI, you're using LiDAR, you're using all these new technologies to make yourself more efficient on the cost side and to expand revenues. That is just beginning. If you look at the tech sector, the Magnificent Seven, it was underperforming the market as of 2 weeks ago, year to date. Now, it is almost with the Magnificent Seven. It has soared past. So we're seeing that broadening out already happen. And that's how we view the next phase of investing in this bull market, is the broadening out of the tech sector and the broadening out of these technologies throughout the other sectors in the economy.
Jose, what do you think that upside then looks like, given the fact that we're almost just getting started and multiples aren't near those concerning levels, at least at all now?
Well, the problem is we assign, these time frames, right? Because year end, because everybody gets paid year end, right? And more money managers want to mark to market at year end. But if you look at the 94-95 experience, again, the Fed raised rates. They doubled rates from 3 to 6, and they cut them 75 basis points over the next 7-9 months. That was it. Fed funds averaged 5.4% throughout the rest of that bull market. So in my mind, you've got a growth momentum, and the cyclical side of the economy is slowing, as you both mentioned. Look at the retail numbers. Consumers are going from steak to hamburger, right? But real earnings, real incomes are still positive. That's a huge factor. And then you've got these secular drivers of growth that are absolutely monstrous, and there are 4 of them, right? Tech, innovation in tech and healthcare in particular, the re-onshoring of jobs and nearshoring, and the reindustrialization of the U.S. Look at construction and manufacturing facilities growing at more than 50%, 50, here in this country. Number 1 economy in the world, most developed, advanced economy in the world, growing at 50%. We're building, and you talked about energy, look at microgrids, look at off-grid energy production, co-location of facilities. Now that is going to help in a lot of ways, but that's not really in the public markets yet, but that's coming as well. So,
how can investors play the broadening in a higher for longer environment, particularly when the debt picture looks so different across a lot of companies in the S&P?
Yeah, look, we think the consumer continues to look good, not great, but good. Technology, obviously, comm services, obviously 2 sectors we like a lot. Healthcare, we think, does well. If you look from the Fed pause historically, when you go into a mid-cycle slowdown, the key question is, are we going into recession or slowdown? We think because of those secular drivers, we avoid recession, right? So if you're going into a mid-cycle slowdown, the markets from the Fed pause, the 3 major indices, 25 to 30% over the next 12 months. So we're right on track for that. We're fine. And we think you want to focus as well on financials. We like financials because as the yield curve uninverts, right, or de-inverts, I don't know what the made-up word is of the day, you get that positive slope to the yield curve, financials should do well. And as the cyclical side slows, we'll see some of that creative destruction. You'll see some M&A, right, and a lot of new companies popping up. So.
Jose, I'm curious what you make of the activity that we've seen in the bond market, because here we are, we have the 10-year yield back just around 4.4. What is the bond market telling you just in terms of the read that we're seeing for what the Fed is going to do, what exactly that means for equity positioning, and then maybe some of that volatility that we'll likely see at least in the short term?
Well, it's interesting, right? Because the Fed communicates and everybody listens. Yeah. Janet Yellen communicates and everybody seems to ignore it, and I don't know why. She warned us when we pierced the debt ceiling last year. She said we have to issue a lot of debt. Almost a third of U.S. government debt had to be reissued this year. That is coming in blurbs, and like huge blobs that are hitting the market, right? And that, if you look at the fall, they issued a ton of paper. What happened to the market? Rates backed up. We had trouble digesting it, right? Same happened in March and April. We think the direction for rates is down. We've seen the policy rate pause. The next move we think is down. Inflation will stubbornly continue to move lower. Everybody talks about tech, right? Nvidia, AI, all these wonderful things. Nobody focuses on what does it contribute? Deflation. Deflation in certain sectors, healthcare, et cetera, fintech. You're going to see a lot of lower prices for goods and services, I think, over the next 12 to 24 months. That's going to help push the inflation rate down as well.
That's so important, though, what you just said, because that's what the Fed wants. That's what's like really driving the conversation right now. What is the main catalyst for that in terms of something that's not going to cause too much pain, right? How do we get the Goldilocks of that scenario?
Yeah, well, and that's the fine line that Powell's talked about that he's walking, right? And we think they can pull it off. I mean, people act like there's never been a mid-cycle slowdown. It's happened twice that we know of, and you could argue the late 90s, the most recent before COVID could have been another. Yeah. Right, we were on our way to that, we felt. So we've seen it before, and the trick is to make sure that the unemployment rate doesn't go up too much. There will be a long-term rise in the unemployment rate due to AI, but what nobody talks about is, let's go back to the Amazon effect. Many politicians talked about the Amazon effect and how horrible that was, right? Because we lost 300,000 jobs in retail in the last business cycle. We gained 1.4 million jobs in logistics, distribution, warehousing, trucking. And they were higher paying jobs. So yes, we're in for change. And yes, change is scary. But we think we're going to have a better economy, more resilient economy, and we think smarter cities and all that will benefit the average American.